Today we have with us Mr. Nilesh Shah, Managing Director of Kotak Mahindra Asset Management Company. We invite him to share his perspective on equity markets from the mutual fund point of view. We have seen that there has been a lot of volatility in the equity market globally recently. This has caused a lot of confusion in the retail investors' mind. Do you see a far greater fall from this point of view? Do you see it getting worse?
So today if we see Indian market, they've fallen from the top much lower compared to, let's say, other markets. China is down 40% from the top. Compared to that, we can't call our market volatile. Second, in equity market, the nature of the market is to go up and come down. If market was constantly going up, then how will investors get chance to participate in the market? So the corrections are part and parcel of normal market cycle, and hence it should not be confused with the word volatility without understanding the context of the volatility. The prices go up, prices come down. The value of the business doesn't go up and down dramatically. Now, if we see today's environment, our markets have corrected for two reasons. One, global factors. Second, local factors. On the local factors side, there are certain events which have happened which has resulted into markets to correct. So June monsoon was good against the expectations that monsoon will be bad. But the August monsoon came 22% below normal average. Obviously, when you have lower monsoon, it has an impact on rural economy. Second, some of the crucial reforms bills which were expected to be passed in parliament session, like the land acquisition, like the GST bill, like the labor reforms bill, they didn't get passed, and market is feeling that there is no clarity on it. Third, the first quarter GDP number came at 7% against market expectation of 7.4%. Now 7% per se is looking good, but against the expectation, it is underperformance. So these are some of the local factors which have resulted into corrections in the market. On the global side, there has been a lot of volatility in Chinese market, and consequent to that, there has been reasonable volatility even in the developed markets like Dow Jones and so on and so forth. Now, those global factors have also resulted into corresponding corrections in our market. So on a relative basis, we are better off vis-a-vis China, but on an absolute basis, our markets have come down along with Chinese markets and American markets. This global factors in some sense is resulting into FII sell-off. And we have seen in the month of August more than $2.5 billion being withdrawn by FIIs. Now, FIIs are not a homogeneous entities. They are very, very diverse set of entities. There are sovereign funds, there are long-only funds, there are hedge funds, there are exchange-traded funds, there are country-dedicated funds. What we understand is that today's selling pressure by FII is from the exchange-traded funds and sovereign funds. The exchange-traded funds are essentially retail investors around the world. When they see media screaming that the world is coming into recession, Chinese markets are crashing, obviously they become nervous and they withdraw their money. Now the ETF manager has no discretion in terms of putting redemption. He will put the redemption at the day when he gets redemption. He doesn't look at whether he's selling cheap or expensive. The second thing is the sovereign funds. Now majority of sovereign funds in the world are based out of countries which had natural resources like oil. Now they have to sell because with the drop in oil prices, they need money to support their local economy. So they are not giving judgment on Indian market when they are selling Indian stock because they need money for their local market. So we are seeing this selling dominated by ETFs and sovereign funds. And at the same time, in some of our offshore funds which we advise and manage, we are actually seeing net inflows coming in from institutional and retail investors. So my feeling is that today's FII selling is dominated by exchange-traded funds and sovereign funds, whereas other segments of FIIs will probably continue to invest into India. Now, with this correction, our markets have become cheaper vis-a-vis what they were, say, 1 month back or 2 months back. From a long-term valuation point of view, we are just little below fair value compared to just little above fair value a month or 2 months back. And hence, we still believe that the bull market is continuing. The bull market has ended for traders because now there is no unidirectional movement. But the bull market has continued for the investors. In fact, it has become better with this correction.
What do you think will be the key driving factors for the market going forward?
So in the near term, obviously people will look at how the global growth scenario is panning out, whether China will be able to arrest the decline, whether globally economies will start moving back into 3% to 4% growth band. From an Indian point of view, what will be critical is how US Fed gives their comment about rate hikes on 17th of September. That's one event which will have a careful watching by all over the world, and also which could have a material impact on our bond market as well as on our equity market. More importantly, what we do locally is something which will drive our market. Now, if we cut interest rates more faster, more rapid than what market is expecting today, that will be positive for bond market obviously, but also positive for equity market. If the government is able to push through reform bills like GST, labor reforms and land acquisition, then certainly it will be positive for the economy as well as stock market. If we are able to see earnings recovery in corporate India, whereby either because of their operating leverage or because of their financial leverage or because of the strength in the domestic economy, which allows them to leverage their business optimally, all those things can again be supportive for the market.
If there is an incremental crash in the equity markets in the near future, what do you think should be the strategy for a retail investor?
So normally when prices correct, valuations becomes cheaper. And on a fundamental basis, India appears to be better and better every day. Our fiscal deficit is under control, and unlike in the past where some amount of subsidy was carried forward, this year subsidies are accounted appropriately. Second, our current account deficit is under control, and despite spending a lot of money on gold imports, we are in a far more comfortable position in terms of current account deficit. We are probably the only country in the world where interest rates can be cut. If Japan, Europe, US have to revive their economy by cutting interest rates, how much they can cut from 0% interest rate? But we have the luxury of cutting interest rates by more than 700 basis points if needed to support our economy. If we see inflation, when the world is talking about deflation, and we still have little bit of inflation left in our economy, and in a deflationary environment worldwide, obviously inflation will remain under control. From a government point of view, obviously the focus is on development, on growth. And yes, we do have to face the problem of slightly weaker monsoon, but overall our macros looks far more solid than what they were what were comparable to other countries. And hence, if the market gives correction, this will be a great opportunity to invest into the market.
Which are the sectors that you would consider as attractive from an investment point of view, and why? Please also do tell us which are the sectors that you would look at avoiding and the reasons for them.
So as of today, the market is going to be far more focused bottom up than top down. Obviously some sectors will do well and some sectors will not do well, but there will be a lot of diversion within the sector in terms of performance. Some of the sectors which are avoidable are linked with the commodity, when clearly commodity prices have corrected and it is unlikely that they will go up in a hurry. And hence commodity producing companies, whether they are in metal sector, whether they are in mining sector, obviously are probably worth avoiding right now. The second sector is real estate. We believe real estate prices will correct and hence it will have an adverse impact on real estate sector. The third sector to avoid is linked to infrastructures, especially power and telecom, where current policy mechanism is such that it will not be rewarding for the shareholders. It's not that power and telecom industry will shut down, but they will work lesser for the shareholders and more for the government in terms of paying spectrum fees, or will have far more competitive scenario which will impact profitability, or it has to still clear a lot of policy logjams related to power sector. So these are the sectors where we believe unless until some catalyst happen which changes the fortunes of this sector, it is not worth investing into. On the other hand, there are sectors or there are companies within sectors like technology, pharmaceutical, consumer staple, interest rate sensitive sectors like automobiles, cyclical sectors like cement, where on a bottom-up basis you will be able to find good companies at reasonable valuations. The one big sector, banking and financial services, is where we have to see how policy impacts the fortune of this sector. The Reserve Bank of India has come out with a draft guideline whereby it is pushing banks to price their base rate or price their credit based on marginal cost of funding rather than total cost of funding. Now this step can be detrimental to banking sector from a profitability point of view. Now we don't know how the guidelines will be made effective into law, but that's why we need to observe and then take a call on banking and financial services. Again, at the cost of repetition, I would like to say that it is the stock selection which will deliver return rather than sector selection.
What is the advice that you would give to a retail investor in this kind of market?
So one, the retail investor should realize that if China slows down, it is beneficial to India. We have $38 billion plus trade deficit with China, and with slowing down of China will have very, very limited impact. Second, China slowing down will also mean lower commodity prices. India is one of the largest consumer of commodities, and lower commodity prices is better for India. Third, as China slows down, the investors around the world will look for an alternative, and certainly India will be on their radar. So we will see enhanced investor participation, be it on FDI basis or on FII basis, if problems of China continues to persist. The US Fed rate, if it's raised, one, it is something which market is already knowing. Fed has prepared market for rate hikes over a long period of time, and hence it will not be a big shock to the market. It will be something which is already factored in, already priced in, already anticipated by the market, and hence it's not going to have any material impact unless until the extent of Fed rate hike is far more than what is predicted by the market. We don't think though as of today we have to worry about such scenario. Now all these things gives you comfort that the global factors are actually working for India rather than against. On a domestic basis, from a macro point of view, India today stands at a much better solid ground compared to many other countries. Fisc under control, current account under control, inflation under control, growth still averaging at 7% level, reserves are comfortable at $350 billion. I mean, clearly we are in a far better position than many other countries. Will markets be volatile? Of course they will be volatile. Will anyone know where the markets will bottom out? The answer is clearly no. What we will recommend investor is that you divide your investable surplus in two parts. One portion please do an SIP, and the balance half you try to invest on a day when markets have corrected. Make volatility your friend rather than your enemy. Put little sums of money whenever markets are correcting so that your average entry price is at a lower level. and then give some time to fund managers to make money on this. We invest in businesses, we invest in companies, and they can't give returns overnight. They go up and down in terms of price, but not necessarily up and down in terms of value. And today markets are at just little below fair value. They have not become aggressively cheap like they were during 9/11 or October 2008. But they are still just little below fair value. And hence you need to give us little more time to create returns out of this environment. So do SIP on half of your investable surplus, keep balance half to invest on a red day in the market, and then sit back, relax and enjoy, and give time to fund managers to generate return on it.
Thanks, Mr. Nilesh Shah, for sharing your perspective.